Ladies and gentlemen, good morning and welcome to what role TCI can play in building a more sustainable future. Now, a decade ago, few people had heard or developed deep thoughts about sustainability in the everyday use of the word, which is now. Given what's happening in the world around us, ranging from climate change to shortage of commodities, this topic has come to just about every boardroom. To support knowledge on the subject, we have organized this eighth item in our ICISA Trade Credit Insurance Week. And we're very, very happy about the interest in this week's event with some 3,200 registrations. Now, on a general note, you can ask questions to the presenters via the question box on the bottom right-hand side of your screen. Given timing, we might not get around to answering all the questions, but we will endeavor to answer these offline. But first, it's my great pleasure to introduce Petra Hielkema to you. Petra has agreed to be with us for the next 30 minutes. She has been the chair of EIOPA, the European Insurance and Occupational Pensions Authority, since May 2021. Having said that, she is no stranger to our industry. Her impressive CV includes postings in Kazakhstan, in the Kyrgyz Republic, and consultancy before joining the Dutch National Bank, where she headed up the insurance policy unit from 2012 to 2015. And with a few intermediate steps, she became the Director of Insurance Supervision. In her various policy speeches, ESG has shown to be a topic very close to Petra's heart. And that's why we're honored that she has agreed to speak with us today. Petra, the floor is yours.
Yes, thank you very much, Richard. Thank you very much for having me today, and thank you for allowing me to also talk on this particular topic today. Indeed, this is a topic very dear to my heart. I think it's a good topic also to discuss in the setting of insurance. I see a lot of possibilities for insurance when it comes to this topic, and I hope that by the time that I finish, and I'll need about 15 minutes, I hope you understand why, and I'll be happy to take some questions afterwards. Now, let me say that this session about sustainability very much is a key topic, not to EIOPA, but also to insurers, and that includes also covering trade credit and surety, although you are far from the only ones that need to look into this. Losses from credit risk originate from customers' insolvency, from customers' default and bankruptcy, and what we see in the current international context is that companies more and more not only insure what we call the normal non-life or damages, but I think more and more we see that they also insure their account receivables from political risk, from economic risk, from social instability, including fallout of war. And in a similar vein, I think surety bond providers cover expenses incurred by obligees arising from unhonored contracts by principals who are unable to cope with sustainability risk, geopolitical risks. So while governments have intervened in the past, we've seen that in COVID to address the distress in the credit insurance markets at the beginning of COVID, I think it remains unclear what would have happened should the sector experience renewed distress in that form. And so there is a lot of uncertainty in the market. There's a lot of volatility in the market. Looking back doesn't say much about what we might expect going forward. And that holds for our entire financial sector, for the insurance industry, and for surety. Now let's focus on sustainability and how that fits in the overall picture. So the materialization of climate risk very much also impacts the ability of economic agents to pay for what they need to pay. And so it can have an impact on trade credit insurance and surety bond providers. Full stop. That's the logic. In my intervention, I would like first to discuss with you the importance of creating environmental sustainability to manage the climate risk and minimize its impact on the economy and the insurers, focusing on climate-related physical risk. And I think what you clearly hear me do is really approach this from a risk perspective. There's many ways to green the planet. There is many ways to look at ESG. But I think when we look at that from an insurance and from a a financial perspective, has sustainable finance. It's not about being green, it's about becoming green, because when we become green, we deal with the risks that are very much there. And in my speech, I will touch upon the urgency to act to generate sustainability, and also the role insurers can play, and also what we do as supervisors as IOPA. Let me start with sustainability. I've said a bit already, but why is it so important? Now, physical risk is very much a case to the point. We regularly see now in the news how climate-related physical risk, climate extreme events, droughts, storms have an impact, a negative impact, a significant negative impact on society, on economy, on insurance, who see their damages go up. If physical risk materializes, it leads to damages to properties, to infrastructures, businesses, lower productivity. Households' wealth, consumptions, and business investment are reduced by losses that are incurred. And then this is only from the whole ESG perspective. I'm only talking climate risk, mind you. Now, this is for sure also important for trade credit insurance, because losses reverberate through the supply chain and disrupt the ability of buyers to pay for the goods and services they purchased. One would expect that companies, as well as citizens that see this risk also growing and would worry about the consequences, and so would all buy insurance coverage to deal with this risk. However, this is not the case. We see currently that only 35% of losses related to climate change risks, to extreme weather events in Europe, are insured. And we know that because we built a dashboard of insurance protection gaps for natural catastrophe, and we also did a sensitivity analysis. And we know that in some EU member states, there is a big vulnerability for certain perils because there is very limited insurance coverage. If you look at this through the lens of macroeconomics, that is rather worrying, since the pace of reconstruction, the output of recovery can be a lot faster if there is finance, if there is insurance, and then the overall welfare loss can be lower. In the absence of insurance, that becomes more difficult. And we do see sometimes public authorities stepping in, but is that really the solution that is most efficient? This is a question. And this is the question related to protection gap. And I'll say a bit more about that in a second. Now, let me discuss the specific impact of climate risk on the insurance sector. Now, insurers' exposure to both physical and transition risk is a cause for concern, and that's why it's so high on our agenda. Looking at the insurance balance sheet, the liability side is affected by physical risk through property, content, and business interruption insurance contracts, particularly with increasing climate-related hazards. For trade credit insurance, customers' inability to pay can, as a result of an extreme weather event, can impact you. And on the asset side, that was liability side, on the asset side, insurance assets can also be impacted by natural catastrophe, as well as by investments in fossil fuels exposed to transition risk. And here again, we did a sensitivity analysis. I would say it's a stress test, but we didn't use the word because the word costs a lot of stress, so we called it sensitivity analysis. But we did that sensitivity analysis on transition risk, and particularly for those who are in fossil fuels, we see that there is a risk of impact on the asset side. Now, being explicit about the negative consequence of climate-related risk for the economy, society, and insurers brings a sense of urgency to us all and calls for some action. And one of the first steps that can be taken is to address this protection gap. And here, insurers have a role to play. First of all, by looking at the risks that are there and see if they can offer products that can cover that risk, particularly physical risks. However, just expanding insurance coverage will probably not solve the problem, because the pace at which we experience currently extreme climate-related events and their intensity leads to the question if you can underwrite everything. And here I'm very happy actually that the European Commission is starting roundtables now with industry, also with IOPA. They do that together with DJ FISMA and DJ Climate to discuss natural catastrophe risk and how that can be insured, and to what extent also a public role would be necessary. Where insurers step in, of course, they need to assess, they need to underwrite. Underwriting risks are going up, premia are going up, and that leads to another risk, which is that it could become unaffordable to have an insurance for a certain risk. Now, affordability in itself is not the only problem. Because what we also see is another way of raising prices is, of course, to exclude the risk. And this is what currently is happening. So more and more that insurers see that a risk, recognize that they need to assess sustainability risk, does not per se result in more insurance, more coverage, or higher prices, but it also results in exclusion. And that means that insurance becomes unavailable, but moreover, that risk is not insured or even uninsurable. That leaves an economy and citizens exposed, and that could then again impact also on other parts of the financial market. Now, this concern was already there. But now, in a time of rising inflation and a cost of living crisis, this could even become more urgent. For customers right now have to make decisions. And sometimes, with rising energy prices, foregoing protection against what is often seen as a remote risk can be an easy option to find the money you need to go to the supermarket today. Now, how do we prevent this situation from further developing? One way where we feel that insurers can really play a very positive role is impact underwriting. And that means that we're not only narrowing the gap by accepting it is there and trying to insure it, but to narrowing that gap where possible through adaptation and mitigation measures. They are essential to manage the underwriting risk and improve the affordability and insurability. And insurers can facilitate the implementation of such measures by policyholders by using a build back better approach, by using risk-based pricing, by using contractual terms, and including that in their underwriting strategy. More specifically, trade credit insurers could consider to include environmental sustainability in their due diligence and credit rating processes. Um, when surety bond providers assess infrastructure projects before guaranteeing for the principal, they could also include environmental risk in their evaluation. To be frank, if you do an evaluation of risks, how can you not include sustainability risk, climate change risk if it's there? Now that's the first. What else then? And this is how we incentivize, or how the industry can incentivize businesses and customers. What can the industry do also for themselves? Are they doing their best to minimize the impact of climate risk on their own balance sheet? And what do they do to understand the risk that they themselves actually run in this time of climate change? Now, what we see is that climate insurers need to do a little bit more homework, and some a lot more homework actually, to better understand and manage the climate risk that they run themselves. And one way to take action is to integrate climate change scenarios in your ORSA, in your own risk solvency assessment. Now, that sometimes is hard. We appreciate that. Some already are doing it, but many are not. And if they do it very high level. So that's why we published an opinion where we said that we really feel that it would be good to include these analyses. But we also published an application guidance. It's application guidance, not guidance. So it's less binding. So those who are already underway, keep going. But those who need help, hopefully benefit from the document. In the document, we set our supervisory expectations on how insurers should consider the impact of climate-related physical and transition risk on their balance sheet, and they do so in the short and long term. Now, I'm very much aware, and because we do consultations, we listen to industry, that industry is facing challenges in integrating these climate change scenarios in the ORSA. And the public consultation we recently did show that there is quite an endeavor happening, and that it is particularly happening in the terms of the time horizon and the data availability and the data quality. Those are the main concerns right now. So we ask insurers, therefore, to only test the material risk against two long-term scenarios, and we leave room for some flexibility. So we still say do it, work with what you have, but only do two long-term scenarios, and allow for some flexibility, for instance, on a scenario update halfway. Now, let me spend a few more words on the time horizon, because I know it's a very sensitive topic. So the time horizon of climate change and the ORSA are not really synchronized, let's be frank. Still, the impact of climate change is something that happens in the long term, but it also is visible today. And that is difficult to reconcile with an assessment of impact of climate change on a company's current business model, and it maybe suggests we need a new approach. But what we say is you should still make an effort to improve the implementability of the scenarios. And what we see is that here the financial community actually has a lot to learn from the climate modeling community to eventually translate some of the key climate variables into variables relevant for the insurance sector. So giving you an example, we see, for example, that an increase in heat waves or changes in rainfall mean losses and has an impact so on your underwriting risk and on pricing. But how would you include that? And we think looking more at what climate modeling community participants are already developing might help here the insurance industry. What we also say is while you work on those two long-term scenarios, it would be good to also include a short-term scenario. And for example, a trade credit insurer relying on a long-term scenario, that's a very good start, but still you might miss an extreme weather event or a natural catastrophe in a geographical area where your buyers are located. And including one short-term scenario for that particular area would then be helpful for you to assess your risk. Now, a further, I think, very good and useful application for climate scenarios is, of course, stress testing. And I already referred to it. We've been doing that too. For it just helps you to identify the channels through which the risk can impact on your company. And this is also an area where we have concentrated on. We have published methodological principles for insurance stress testing that is focusing on the climate change components. You can find it on our website. And we really made an effort to integrate ESG risks both in the methodologies that we develop, but also to provide guidance on how you could use that going forward. For also we as supervisors, of course, have a role to play. And so in the last part of my remarks, I would like to highlight some of the work we've been doing beyond what I already mentioned. Now, we've talked about the protection gap, and I think there's a lot of work going forward. In fact, if I currently go, and I'm happy to be able to go to more also in-person conferences, and then you meet a lot of people from different countries in the EU, different insurers, but I hear with everyone the protection gap being top of mind, particularly on the non-life side, of course. Although on the life side, the pension gap is an issue, but let's focus on the non-life side. Now, what we have added to that at EIOPA is the expectation gap. Because often policyholders are under the wrong impression that a certain loss is covered by their policy while it is not. And it might to a certain extent also explain why the number of insurance for these risks, 35%, is so low. But sometimes also the product is not available, and that is because of the exclusions that I already mentioned. Now, what we're currently doing is we are doing a behavioral study to see why consumers did not take out the insurance in the area where the flooding was last year in Germany. We're very interested in finding out more and understanding better what drives the consumer to take out insurance, and also what would be needed to convince them to take more cover. But we are also, of course, looking at these exclusions, and we actually publish for consultation now a supervisory statement on exclusions of risk for systemic event, including natural catastrophe. And we're looking for feedback, so happy to hear from you. The goal, of course, is that we minimize the expectation gap. Why? I think, first of all, it is not good for the trust in the industry, but also, secondly, I think if the expectations are more accurate, there also might be more incentive again to deal with the protection gap. Now, I'll conclude. I mean, how can I do a speech and not mention Solvency II? So I would like to conclude what we also do in the context of the Solvency II review. Naturally, the Solvency II review started with a Commission proposal and is currently still negotiated, so there is no final text. But what I can say is that I'm very happy with what was in the Commission proposal when it came to sustainability risk, which of course is twofold. It's first of all the need to reassess the natural catastrophe risk module every 2 years, and I think that's good because we get more and more information and experience, so we can be more accurate. And the second part is to look into the need for risk differentials for insurance in Pillar 1. Now, let me draw my remarks to an end and leave some time also for discussion. Just to wrap it up, we've seen that creating sustainability, becoming green, not being green, but we need to become green. It's a transition. It is key to address the climate-related risk. Insurance can play a very important role in managing physical risks, in filling the protection gap. But here, adaptation and mitigation measures are very much needed. And here, insurance can do more to protect consumers, but also to incentivize consumers to mitigate and to adapt. And at the same time, insurers can also do more to protect themselves, their own balance sheets for climate risk, and they should do that a bit more actually. And a way to do that is including climate scenarios in the ORSA, even though that can be sometimes hard. We should also consider policyholder preferences, and see how we, from a conduct perspective, can have a dialogue on how they perceive their risk, their expectations towards risk, and how we can make those more realistic. And finally, further work is underway on the prudential framework to manage sustainability risk. And in all that, I also feel that your particular part, special part of our industry, can play a significant role for the risk. Climate change risk, sustainability is very much also a risk that you need to face. But the channel through which you can also incentivize your clients to make sure that the amount of risk that needs to be covered remains manageable, I think is very important. And with that, I'll stop and I'll thank you for attention, and I'm happy to take some questions. Back to you, Richard.
Well, thank you so much, Petra. And I think you've given a lot of comfort to the audience and to my members about the going green, not being green, because this is obviously not going to happen overnight. But at the same time, you were very clear that the insurance industry needs to take some actions. Now, my question is, where do you see the biggest risk coming from across the insurance sector if adequate action is not taken on sustainability principles? Is this a prudential question, things like connected risk, stranded assets, cost of capital, or is it something else in your opinion?
Yeah, I think it's multiple. That I think would not surprise you. So for sure, if you are not yourself as a business aware of the risk that can impact you on the asset side, I think you can run into unexpected problems. Sometimes on the non-life side, it's argued, well, we can raise our premiums every year, but I think there are limitations to how much you can raise, and definitely in a time of cost of living crisis. So I think that's one risk. I think there's a reputational risk, which is related to the expectation gap I addressed. So there's an expectation that insurers are there, had to deal with society's risks, and then everyone can just go out about their business, and they are secured. Now, the moment that that is not happening because of gaps in the expectations or exclusions, which were not clear to consumers, I think that is a problem in itself as well. Finally, I think you hear more and more, and I have not seen it happening, but going forward, it could be a risk as well, is of course litigation risk. And this is more on when you start to become green, when you want to move into that transition, and you not only incentivize your consumers, but you also sell products maybe that you say are more green. Here is the risk of greenwashing, and what if you do it wrong? Now, just to say something about that, I think what is always important is that, one, you don't have to say something is green, but so that's the first. You can still do green without selling it as green if you're not fully sure. If you say it is green, you need to be sure on the basis of all data and knowledge and expertise available today. And then you need to monitor going forward if that is not changing. I think if you do that and you document that well, you can still go through a transition and also say that you are selling green products. So I think here that one is manageable by behavior of the insurer, even though it might be there. It is a time of transition. I think the reputational risk is about closing the expectation gap, being clear about exclusion. But I think the rest is really being not ignoring the fact that this is not just what I said at the start of my speech. This is not just about nice and wanting to be green. No, it's about a real risk that can impact your company, and recognize that and integrate it fully in your risk management.
That is clear, and thank you very much. Allow me one more question, if I may. I know your time is tight. Now, a cynic might say that credit insurers are there to pay claims when non-payment of invoices occurs, and is the responsibility of the policyholders themselves to limit the impact on the environment or society. How would you respond to that?
Unmute. Yeah, so no, I think it's a fair question, of course, and let me say that I agree that first and foremost, the policyholder themselves is responsible for dealing with risks. But at the same time, the raison d'être, the license to operate of insurance is to facilitate risk taking and to manage risk. So I don't think you need to be cynical here. I think there's a shared responsibility for addressing and integrating environmental or social risks in the business planning and in risk management. And I think this shared responsibility lies very much in the prevention and in the adaptation, reducing losses and limiting costs to society. I think insurers are very much positioned as experienced risk managers, as a place where there is data available, to also have a role in that as an advisor for good reasons, but also as an expert. And so I would say that if you do that together and jointly, it's a very logic role for insurers. It's a good question, of course. You could even say, like, as a prudential supervisor, Peter, what is your worry? I mean, if an insurer excludes the risk is no longer there for the insurer. From a prudential perspective, that could actually be a good thing. Huh? But it's not, because we need to look at the purpose of insurance. And if you look at the purpose of insurance and the need to manage society's risk and be really realistic about the fact that sustainability risk is very much a real risk that then I think you look from the right perspective and you understand that there is a role for insurance.
Well, thank you so much, and thank you so much for all your remarks. I think they've been enlightening. I'd like to thank you on behalf of ICISA and the audience. I'm sure usually you would get a really big applause right now. That doesn't happen in a virtual environment, but consider yourself applauded, please. Thank you so much.
Thank you. Good being here.
And moving right along, because you've seen Danilo in a corner of your screen. Now, Danilo is a senior ESG advisor for RepRisk based in Zurich. RepRisk is a pioneer and leader in ESG data science using machine learning and analytics. Their vision is to be the global standard for ESG risk and due diligence, and their mission is to provide transparency, to drive accountability, and create positive change. Now, let's put this very plainly. If things don't get measured, they usually don't get done. And that is what RevRisk has as a goal. It is the essential part of putting ESG strategy into practice. And that's important, right? Not only for the regulator, as we just heard Petra say, but also to society at large, to the investors, and don't forget, please, your employees. Now, Danilo has a business degree from the University of Siena, and I am very, very curious to what he has to say. So take it away, Danilo.
Thank you very much, Richard. Really nice to be here. Really important to be here. I think that the topic is so vital nowadays. And I really liked how you shaped this panel. The role of TCIs in general insurers in building a more sustainable future. So if you don't mind, I will be sharing some slides. I think it's important to present here. So you should be able to see now some of the slides. And I mean, I will start really the role of insurance, which is of paramount importance. And I will start now with the founding act, let's say, of the PSI, the Principle for Sustainable Insurance. Back 10 years ago, at that time, UN Secretary General, I think he really set the bar very high, and rightly so. As if you look at his comments at that time, where insurers are really important, are really crucial in providing us with all those solutions for renewable energies, clean water, food security, and so on, that the society needs. And that is something that is also has been echoed by following works of the PSI, the Guide for No Life Insurance 2020, recently also for life insurers, and again stressing the importance that insurers have in promoting a more sustainable future for all of us. And I mean, I think it's really the essence of it, and it's really the central point. Insurers must be part of the solution, and are a great part of the solution, as banks are, for example. So if you don't have an insurance sector who is steering, who is pivoting the action of companies, then of course, as for example banks do for the lending part, for the capital market, then of course our society will find it far more difficult to go into that path of sustainable development, of becoming green, as Peter said. But it's not only green, is of course there are other parts to ESG. So I think it's a no-brainer that insurers have a huge part, a huge responsibility, huge opportunity actually to play in this. I would also like then to look at also the other part. So of course insurers can do so much for a sustainable future, but also sustainability, ESG consideration can do so much for insurers as well. So in a way, the other side of the equation, I'd like to focus on this side of the equation. And this is really, I think this is really important, the importance of ESG data, sustainability data, and I would stress ESG and sustainability risk. Again, coming back to one of the comments from Petra before, I think it's really important to focus on the risk side, being in this environment for insurance. And this goes for underwriting, goes also for investments, where in a way we even have more information, we even have more data of how important, how effective are these ESG consideration. But also I want to, in a way, spell a myth. I mean, somehow ESG is not the discovery of America. Companies, insurers particularly, always consider some degrees of environmental issues, particularly, and other issues when doing, for example, risk assessments. I think the concept of ESG is to taking this to another level and use this data in a more systematic way. And if we are really looking at why ESG data, why sustainability data are important for organizations, I would say the first level of importance is really for the whole organization. So for the company as a whole. So it's really, the first part is really the reputational risk. ESG can impact a company's social license to operate. As a client of ours put it, you don't want to be that insurers that has been linked to that everybody's talking about for the wrong reasons, of course. That is, has done, has insured a very controversial company, or some very controversial projects. So it's really important that even especially at top of the company, the companies, management is aware of the reputational risk which are related to the operation of insurances. And related to that is also, the importance to ensure that you are running your business in compliance with the company's own policies, with the company commitments, the public commitments. And particularly because more and more regulation are coming from all sides, basically, or all countries, that you are running your operation in compliance with international standards. We all know the UNGC principle, OECD guidelines, Equator principles, and so on. These are, in a way, the golden standard, or from the other side, the red flags that the international community said shall not be trespassed. So, of course, if you need to be sure that your organization stays within the boundaries of these standards. More in general, ESG is so important for the organization. I'm still talking about let's say, the old structure on a different levels. So, for example, it is important to attract talents. I mean, I think a fair amount of people in this room will have experience when you're looking at a new employees, a new person, new blood in the company. They will ask. They have quite high expectation in terms how the company is behaving in terms of ESG. Your investors will ask a lot of information, how the company is behaving. That impacts also the cost of capitals, your lenders. So these are all considerations why ESG data are important for the organization as a whole. At the same time, ESG data are really important when it comes to let's say, the core of a business, so underwriting, because all these considerations that we just discussed about just now about ESG data impacting the operations of the company. So, of course, that means that they impact the credit worthiness of companies, and that means that then they will have a cascading effect on the likelihood and of the size, of the magnitude of the claim. So that's really important. There are also, for example, really interesting papers which have been published in the last few years, particularly for corporate credit, for example, because of course there it's also easier to find information. And they show, there is a relationship between ESG risk, ESG rating, and credit worthiness of companies. So that is really where ESG data can play a really important part in the operation of a trade credit insurance company or for surety. It's also, in general, I think when I'm talking to our clients are using conversation about ESG with the top management of their clients, to understand also a bit more the DNA of the company. How is the fabric? How is really the risk structure, the risk management of the company? How do they take risk management in consideration? So it's very good proxy. ESG data are a very good proxy of the overall risk in the operation of companies. And also there is another part which is quite interesting. Again, for example, of course, we do run studies also with university academic institutions. And for example, one paper which was done, actually two papers, one by University of Virginia last year, this year by Moody's, and they both showed quite an interesting point, that there is a certain stickiness in terms of risk exposure of companies, meaning at least for the short and medium term, particularly, your past exposure to ESG risk is a good prediction of what is going to be your future exposure to ESG risk. Again, this is something that can easily then or effectively be implemented into risk models of companies. And this is also what we see more and more, this data being used really to drive and improve the risk models of insurers. So I think these are the main reasons why ESG data are important for insurance. I even didn't mention here all the parts about investing. This was mainly due to what perceived time constraints, let's say, but I think if you want, we can spend a couple of minutes here. And again, here for investing, there is even more evidence now than a proper ESG integration delivers better risk-adjusted results. Now, I'm talking about ESG integration, which is, of course, something different from investing, ethical investing. Of course, we all have our values. You might want to decide to invest ethically. For a company, there is also then fiduciary duty. You have to be careful on that. But anyway, with ethical investing, you are saying, yes, I'm ready to forfeit some parts of a return because I want to be in line with my values. ESG investing, this is what I'm talking about, is different. It's really looking at all these environmental, social, and governance consideration and applying them in a systematically way. This actually helps you to, in a way, select the companies, the most stable, the most solid companies. So I give you an example, and I think it's really interesting. The Norwegian pension fund, which is the largest asset owner in the world, 1.3 trillion of assets, is publishing every year a risk return report. And what they show in this return, actually for the past few years, is that when they apply an exclusion policy, so they are excluding companies which are systematically violating human rights abuses, they are systematically involved in corruption, and so forth, then they have actually they achieved alpha. They have an increase of return. Now they can do that because the Norwegian pension fund is really amongst the pioneer in terms of ESG integration. So they have long enough data history, so also to compare with past results. But this is really important. So ESG data can be effectively used, and actually is effectively used. I mean, by investors around the world. And some of them are purely, for example, quantitative investment, that even want to look at the qualitative data, or to discuss how companies is presented. They are just looking at the risk signals that are coming, and they are implementing that. So this on the investment side. But also, I think we want to be honest here. There are pain points when it comes to ESG data. So these are points that one needs to consider, because at the end of the day, these data sets have been systematically built, I mean, just for the past 15, 20 years maximum. So of course there are pain points, which I think it's very important for all the actors, for all the players to be aware of. And particularly, in a way, for insurers, that even is a bit more tricky for the nature of the business. Because, for example, one point is the insufficient coverage. A lot of ESG data are being collected and assessed for large caps, S&P 500, Eurostock 600, and the likes. But as soon as you go towards small, medium caps, as soon as you go towards private companies, which of course represents a huge part of your client base, then of course you have less information. And this is also the same for infrastructures, for projects. Again, less information on that. The other one, which I think it's also very important, is the bias that you can find on company disclosure. Majority of the data until now are based on company disclosure. We all know that it's important to get information from clients, from companies. Clients are filling your questionnaires and so on. But clearly there is an inherent bias there, because the company can have simply a hidden agenda. They may want to underplay the risk in their operations and so on. And actually, if there is a history in terms of ESG risk incidents, which then became, for example, crisis in terms of market valuation, credit worthiness, and so on. I mean, in none of these cases, these companies said in advance, yes, we do have some problems there. It was all good until it was too late. Also, another part is clearly that these are a lot of information are not fast enough. No, the frequency of the updates is not fast enough. A lot of yearly, semi-yearly, or quarterly updates, which of course can be a problem when you want to monitor emerging risk. And also, I think there is some part of soul searching that we as an industry of ESG data provider have also to do. So we have a lot of time ESG ratings or metrics are kind of a black box, so you don't know what is behind and how that was calculated, and also confusions between the different methodology. I think at one point it's also part of the game. ESG is really, you are considering so many different issues and topics and data points from inclusion to corruption to loss of biodiversity and so on. Then of course that brings to a degree of difference. So the point that I'm trying to make here is really that also when looking at new ESG data set, it's really important to do your homework in a way, to ask tough questions, how the universe was created, was there any backfilling, and how the methodology has been created, and do throughout tests. That is really, really important, because again, these are quite ESG are information that are coming from different areas. Really, they are then typically condensed in only one metric or some area of metrics, and then you need to be careful. But also I would go to another point is, if we see our the most sophisticated of our clients, what we are doing is actually using the raw data, the data that we offer. So because they, at the end of the day, it's them who have the whole picture, can put together all the different pieces of a puzzle. So ratings are good, but for me, these are just, for us, as the way we think at RepRisk is just the tip of the iceberg. The added value for you as an organization is in the raw data that then you can implement, you can plug into your models, in your system, with also your expertise. So you can give that twist that at the end of the day will allow you to achieve better results. I think this in general is also the the challenges of the market. I'm telling you now a bit more about us and how we do that. So ESG data analysis. So it's really, as the name itself gives away, risk risk management is really part of our analysis. And I think also we are very well positioned to cover all the points that I mentioned, the pain points that I mentioned before, because we have the largest database in the world, which is not only listed companies, but above all, private companies, largest coverage in the world for infrastructures, also for countries and for sectors. With an outside-in perspective, meaning we are not looking at what the companies themselves are saying, we are looking at what the external stakeholder says about these companies, and this allows us to really be a kind of counter check on company provided information, see if a company really walks the talk. And the data are daily updated, so you have all the data since 2007 with daily updates, and we do that with a combination of AI and human intelligence. So we have over 120 analysts who are looking into that. And as you can see here, a lot of inputs. I will not go into details here, but a lot of inputs and a lot of outputs that we give for our clients. As I mentioned, we work with several insurers, reinsurers as well, ECA. Some of our clients have been kind enough, you see here from Euler Hermes. We have also from such, and so to really put in public, in writing and in public, the importance of rep risk. And from my side also, what I notice is that insurers are were a bit of late starter compared to banks in terms of ESG integration, but they are catching up very, very soon or very fast. And also, I think they are really ideally positioned to do that, because you have already the statistical expertise, the mathematical expertise to ingest different data sets and make them work to increase the efficiency of your models and the operations. I think also what is important, and then I will stop here and leave in case you have some questions, is that you can use data, and I think also Petra referred to that before. I think what's the beauty of ESG data is that can be used at micro but also macro level. So it's important to look at single companies, it's important to look at single projects, but then you can zoom out and then you can look also at what are, for example, the exposure in a specific sector within a specific country, especially these days when suddenly in the last few months we saw a whole new, so the world we have all been living in terms also of globalized world imploding, as clearly Russia aggression on Ukraine, but also the relationship with China and so on. So it's geopolitical risks are becoming more and more, or have become more and more important. So it's really important to have information on single countries and single sectors to give more weight or more attention to that. With that, I think I can thank you for your time, and if you have any questions, I will be very happy to answer that.
Danilo, thank you very much for that. And yes, indeed, there are a couple of questions. Let me start with the toughest one, please. One of the members of the audience says, how do you see and how could we solve the misalignment between the short-term expectations of investors looking at the optimization of investment return and the mid and long-term component, as well as the cost of a relevant ESG strategy? So how do we put ESG together with the demands of our investors?
It is indeed a very good one. But I think it's really, we have, I quickly touch upon that before. I think we need to make investors understand that there is a big difference between ethical investing and ESG. Now, ethical investing is a different ballgame, and you are prepared to, give away some of returns because you want to invest in companies that are 100% aligned with your beliefs and so on. This is something that started some decades ago with religious institutions across the world and so on. ESG actually per se, if we are looking at ESG integration, I don't see any contradiction in that. And more than me, that you could say, well, you could argue, but I mean, really, not only scholars, but actually investors don't see that. So I give you just some anecdotes. So we are working with hedge funds. So very short term investing, quant hedge funds, sorry, not the heavily research-based hedge funds, but with them as well, but also quant. So it's really daily trading. They are using the data because for risk management and because they want to achieve alpha. Now, I would also be very happy to share, and if somebody is interested, please do reach out to me. So we have papers and show if you're using the ESG risk data, you can decrease the likelihood, for example, of decreases of security prices, and you can and also their magnitude. At the end of the day, you are increasing the risk-adjusted return. Also, another part, which, for example, our clients are seeing is you can, for example, ESG can be a great opportunity if you're looking for a company who, for example, has embedded a very high ESG risk, but you actually see that this company is improving. So that is clearly, but the market has not recognized that. That is a great opportunity because you are exploiting a market inefficiency. So what we as Repris mean with ESG integration is really this one. So it's really business conduct risk. So you're looking at those. I mean, I think incredible work has been done by SASB on this, the materiality map for investors. So also look at what is really material for these specific sectors, arguably also for these countries. And then if I use this information, I can actually, I don't see that dichotomy anymore.
Thank you. That was a clear answer to a very complicated question. And my feeling is that we will still have a lot of discussion on this one in the months and years going forward. And that is exactly one of the reasons why we're organizing this Trade Credit Insurance Week. We want to set the audience thinking, and Danilo, thank you very much. I think you have. And I think you have brought this topic one step closer to operationalizing it, because to a lot of us, sustainability has become a very amorphous topic, and we don't know from which side to tackle it. And your contribution has given push in the right direction. Thank you.
Thank you very much indeed. It has been a pleasure to be here. Thank you.
Now, ladies and gentlemen, our last item on the ICISA Trade Credit Insurance Week will take place at 1500 CET and is understanding the evolving sanctions. Now, that has never been off our radar screen, but given what's happening in the Russia-Ukraine war, it has gained in importance tremendously. Now, speaking to us will be David Harris and Katie McDougall, both partners in Norton Rose Fulbright, the London law firm, and Henry Smith, a director of Control Risk. And Control Risk, as a lot of you would know, is a specialized global risk consultancy. We hope to see you at 3 o'clock this afternoon. Thank you for your attention and see you in a couple of hours.